Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 20th February 2026, and joining Derek to pose some questions on the financial market themes for the week ahead is Simon Mays, Head of FX Sales for the UK and Ireland. This material is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Derek. I believe this is our first podcast together in the new year, so good to see you again.
Yes, and you, Simon?
Cutting straight to it, the dollar's been well bid again this week, so there's various reasons for that. But I wanted to ask your opinions on the escalating US-Iran tensions. Do we expect this to drive further safe haven flows to the dollar? And I guess more worryingly, given the military build-up that we've heard about, President Trump's 10 to 15-day ultimatum, what do you think are the potential FX market scenarios if a strike does occur?
Yeah, I think the dollar has had a good run. Obviously, we've had a good run of decent data. Certainly, Wednesday we had durable goods, housing, industrial production and manufacturing all stronger. And then today, of course, the PCE inflation was on the stronger side as well. So rates has moved, not massively. We've taken out about 10 basis points of easing for 2026 in total. And so that, definitely has supported the dollar. I think the move in the dollar as well, you have to take it in the context of the terrible dollar sentiment that we had in January. It's the worst sentiment I can remember in a long time. And there was a clear build-up of leveraged positioning that I think has now been liquidated. Aussie longs, for example, extremely overstretched based on our Z-score analysis of positioning. Actually, the most overstretched in the series of the Aussie data going back to 2006. Euro long positions were also built up, not to the same degree as Aussie and sterling as well. So I think positioning and just where we were has kind of reinforced that positive momentum for the dollar. And then from a geopolitical risk perspective, crude is up about 7-8% now this week from the low point on Tuesday. And like 10-15-day ultimatum from Trump could mean 1 to 2, couldn't it? So I think markets are nervous about the potential for something happening this weekend. And I think in that context, that's helping the dollar as well. From an FX perspective, obviously, looking at your energy import reliant countries, those would be the ones that you would imagine would underperform. So euro to a degree would get hit. I think JPY as well. When you look back at what happened in 2025, June of last year, when we had the attack on the nuclear facilities, there was a gradual build up to that. Crude oil was up about 16% going into that attack, and dollar yen going into it and initially on the Monday after the attack, dollar yen was up about 3.5% over a 7 or 8 day period. So the yen definitely underperformed, and I think given the assumption that oil would spike further higher, I think the yen would certainly be one of the underperformers.
Yeah, well, actually, sticking on that point on the yen, you've got the US-Iran tensions you mentioned, also elevated Japan-China tensions. We had PM Takaichi's speech today, which defence was mentioned, in that speech as well. So, given improved JGB market stability compared to last year, how do you think this is going to impact yen positioning from here?
I guess in terms of just very quickly going back to the geopolitical reaction and what happened last year, the sentiment last year was definitely worse. So that could curtail the degree of yen sell-off on this occasion. And definitely sentiment has improved. Like we had I think it was a 20-year auction this week, and the bid to cover was weaker than the last auction. It was also below the 12-month average, but JGBs didn't really respond negatively. So I think, the government have done a great job in terms of the messaging to the markets in terms of their approach to fiscal policy going forward. And we had more of that from Takaichi today in the opening of the Diet and the policy speech that she delivered. As you mentioned, Simon, defence was definitely one of the kind of components of that speech. The other pillars was economic security and kind of investment-led spending. And on defense, it was China was explicitly mentioned. So I think one of the takeaways from this is that, that China-Japan tension is probably going to get worse, not better. And I don't think it's going to disappear because her approach is pretty explicit. And I think there's definitely implications from that. Tourism has already been hit, but in the broader scale of the current account position, while tourism revenues are important, it's the investment income that is huge, and that isn't obviously impacted from this. So it has some implications, but I think overall, certainly from an FX perspective, not too much. And then, the markets have taken it well so far, but she also made the reference to the focus being on growth, and that she's going to switch the growth button again and again and again. So how does that tally up with, we're going to be very careful in terms of fiscal spending? So I think there's still a risk that kind of confidence that investors are showing at the moment, doubts could emerge again. And, I certainly think there's risks that we could get some renewed JGB market instability. And with that, obviously, if the dollar is doing well, then suddenly dollar yen will be back up approaching the levels we got to in January before the Fed was checking rates. So the risks haven't gone away in terms of the potential for dollar yen to move back higher.
Thank you. Yeah. So moving then away a little bit from the geopolitical tensions and back to sort of fundamentals, monetary policy. Euro dollar, everyone got a bit excited. We got above 120. I think our forecasts pointing for euro dollar higher as well, but we've seen this retracement of that move. Also, there seems to be a little bit of divergence between monetary policy of Fed and ECB at the moment. We've had Eurozone inflation falling sharply, a little bit of a turnaround in pricing on the US rate side. So how likely is another ECB rate cut in 2026? And what do you think about the implications of this for the euro?
Yeah, we've pretty much, we have exactly nearly to the pip retraced the entire move higher in euro dollar. The opening rate at the beginning of the year was 117.47. I checked it there earlier, so we're pretty much trading around that level now. So the entire move has reversed. I think, yes, as we said at the beginning, in terms of the dollar factors, that's been a big factor in terms of this reversal. From the start of the year, even last year, when we made a call for unchanged policy rates in 2026 for the ECB, we did emphasize that the risk was definitely skewed to the downside because of our FX view, euro dollar going to 125 this year, our view on energy prices going down. Obviously, that's not what's happened this week, but over the year, that's also part of our view. And then wages are decelerating to levels that are more consistent with price stability. So the risks were, given where inflation is today, that we're going to miss to the downside on that the ECB could cut rates again. I'd be reluctant to change that view at this point in time. Clearly, the risks are growing, but there's still only, I was checking earlier, the OAS has got about 6 basis points priced for this year. Now we did have about 2 basis points of tightening price. So we've swung since mid-January about 8 to 10 basis points the other way, which I think has certainly helped to kind of reinforce that correction power. Yeah. But we'd probably hold on to our view of unchanged rates. Because some of the macro data has been pretty good. Yeah. The PMIs, the advanced PMIs today were definitely a bit on the stronger side. And that kind of fiscal stimulus in Germany, that there was always these questions about when it would exactly start to hit the economy. When you look at factory orders up over 10% on an annual basis, you look at these PMIs, there's definitely evidence to suggest that is coming through, and that's going to be a positive for GDP, obviously.
Interesting. And finally, looking forward to next week, are there any key data releases or central bank communications that we should be focusing on?
Data-wise, it's another fairly light week. It's really the week after. Obviously, you've got the ISMs and you've got payrolls. Next week, consumer confidence. I tend to look at the kind of forward-looking expectations on the labour market. Those tend to be pretty good signals of labour market conditions, which actually haven't been that great. So I think in that context, it's relatively quiet. So I would imagine the initial phase of next week will be either responding to something that's happened or reversing some of the trades because something hasn't happened. Yep. So I'd say that's what will probably be the initial kind of moves that we get early next week.
Got it. Something to look forward to next week. Thank you very much, Derek, for your time.
Okay. Thanks, Simon. Thanks. Have a good weekend. Hopefully Ireland win in the rugby.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.